Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss impact of US elections on financial markets.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I would like to discuss US elections and what's their impact on the stock market or financial markets as a whole. I do not want to go deeply into the politics. US elections are this year in 2024 on 5th of November. I have no idea who will be the winner because I'm shooting this video and it's the end of October. But there are some papers that shows that the elections have an impact on the US market, and I would like to show you some of those papers. So firstly, there is an article that was written by us and it's called The Pre-Election Drift in the Stock Market. It's an older article, maybe 3 or 4 years old. It's about the calendar or seasonal anomaly that shows that there is a significant updrift in 5 days before the election. So what we did is that we downloaded the data about the date of the election and from the 1950s until 2018. And we checked what's the pre and post-election performance of the S&P 500. Here is the chart with the performance. So as we can see, from D-5 until D0, and D0 is the day of the election, there is significant updrift in the prices. And afterward, after the election, the movement in the prices is plus or minus the random. Now, if you take a look on the chart, how does it look like? The gray line is only the performance over the election day. The red line and the blue line are the performance over the pre-election days, or the pre-election plus the election day, which is the red one, which is the strongest one performance. The positive performance is significant statistically. On average, the performance is around 2.5% before the election, per election. It's not only for the election of the president, but also for the election of the Congress and into the US Senate. So every 2 years we can try to get some return out of the US market before the elections. This is what I will definitely try to trade before these elections. Really looking forward how it will look like. There is still a time to buy US stocks before the elections, so take a look on this article and on the strategy. Those are not the only strategies that we can try over the elections or after the elections, but all of the other are longer. So of course the President of the United States has a lot of the responsibilities and a lot of the power, so it is understandable that he has also some impact on the financial markets. So here are some of the ideas and some of the strategies that we have in the database that are related to presidential terms. Also we have some strategies that are related to election itself. Here is the pre-election effect that I mentioned. What I would like to show you is further is the election cycle strategy. The election cycle is based on the paper that was backtested on years 1957 until 2004. So we made an out-of-sample test for that. Out-of-sample test shows slightly negative performance in out-of-sample. The idea is that investment strategy is simple, so you should hold equities during the third year of the election cycle, and you should stay out of the equity markets for the remainder of the years. The fundamental reason is that usually the pre-election year or the third year, the president tries insert as much money as it is possible into the economy because he would like to stay in the power. So the third year is the most important year of the election cycle. That's the reason why the third year should have the positive performance. How does the performance look like? We have a positive performance until 2020, but the third year of the previous cycle was the year 2022, which was unfortunately negative. The reason for that is because we had the invasion of the Ukraine by Russia, and of course the year was the negative. So in this case the geopolitical situation was such that the election cycle or the third year of the election cycle was not the positive one. But overall from 2004 the results are quite positive. So the third year of the election cycle is usually positive. But then we have the Halloween effect during the midterm election year. Halloween effect between the second and the third year of the election cycle. Once again, the election cycle is 4 years. So we are 2 years out of that. This Halloween effect will be in 2 years after this year. Once again, the investment strategy is very simple. So we should on every midterm election year, so every 2 years, the investors should buy stocks at the beginning of the December and hold them until the end of the April, and the money is invested in the cash market in the other months. This is how does it look like. In this case, the last 2 or 3 mid-years were not so positive. Once again, there was 2022, which was not very great year, but 2023 until the April 2024 was pretty fine. In 2020 we had the COVID crisis and there was also not very positive performance. So we will see how does it look like. We will learn in 2 years. Then there are other papers that are related to presidential cycle. The presidential cycle is a theory that there is a strong impact whether we have a Democratic president in the US or Republican president in the US. So from the Democratic Party or from the Republican Party. The first idea is that the presidential cycle has an impact on the performance of the stock market. Data from the 1926 shows that the Democratic president is usually better for the US market. I mean, it's a little surprising, but yeah, data shows that the Democratic president is better for the stock market performance. Here we have a backtest. I mean, the backtest surprisingly shows that the paper is right. So from 1926 until 2020, the return differential between Democratic and Republican presidencies were significantly positive for the returns when the president was from the Democratic Party. So our backtest shows the same results. I mean, it's surprising, but this is what the data shows us. And then there is the idea that the presidential cycle should have an impact on the US dollar. So once again, we have a paper written by De La Corte, Pascal, and Xuan Fu, presidential cycles and exchange rates. Idea is once again that on average the dollar appreciates during the Democratic presidential terms and dollar depreciates during the Republican presidential terms. So we should be long the dollar over the Democratic presidential terms and we should be short the dollar over the Republican presidential terms. Now we try to backtest this strategy. I mean, the strategy performs quite well from 1980s. The backtest is of course from 1980s, which is not surprising. Before the 1980s it was plus or minus the random. So I mean, if you believe in this paper, over the last 40 years it works plus or minus well, but before that it was not working very well. So I would say this is not very statistically significant if I should compare it to presidential cycle and the impact of the presidential cycle on the US stock market. So all of those strategies that I showed to you, or all of the papers that I showed to you, are quite long term. What you can do in the short term is go long pre-election drift. So 5 days before the elections you can go long the S&P 500 or underlying stocks. There is a tendency of the US stock market to go up before the elections. But I mean, take care after the elections, because after the elections it's plus or minus the random. Thank you very much. I hope that you like this video. I hope that you know what you will do before the elections and after the elections. If you liked this video, please give us the like. Please subscribe to our channel. You can visit our webpage. There are a lot of the articles, a lot of the seasonal strategies, a lot of the other trading strategies. And I hope that you will join me in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.